Hi everyone. So on this video, I'm going to help you understand the correlation between geopolitics and investing in 2026. Now this video is incredibly important. Why? Because I will help you challenge a common belief. The belief is, and many investors believe that, hey, if we continue to invest our money in FDs or in US equities or in Indian equities, it is our birthright to get 10-15% returns, okay, every year. And if we continue to play that game, we will retire in the next 30 years. Many finance influencers, they create elaborate Excel spreadsheet talking about the next 30 years returns, that hey, if you start investing whatever 20 rupees a month, you will end up becoming like crorepati or whatever crap. Okay, is this true? The short answer is a yes and no. Yes, if you bet on the right geopolitically correct markets, you will make money. If you don't bet on the right geopolitically correct markets, you will lose your entire retirement money. I can almost guarantee that to you. I'm not trying to create any fear mongering. I'll explain this entire topic in 3 simple points. If you study these 3 simple points, it is going to at least make you think. You can further research and align your investment strategies, but at least listen to me. This contrary viewpoint is rarely presented, but right now it is one of the most important things that you need to study. Okay, 3 points I will cover. Number 1, I will prove it to you that US right now controls the current economic setup, and this economic setup is deeply entrenched in the world. It is very, very difficult for countries like India or the Middle East to come out of this. Okay, this is 1. Number 2, there is a decoupling which is happening between US and China. You are seeing that a lot of wars are being fought. Taiwan is now in question. Cuba, US is going to annex. Venezuela, it has already annexed. A lot of things are happening, like Gulf War is happening, whatever, right? But why? Because China has challenged the US, and now there is a decoupling happening between US and China. This started in 2016. In the past also, such a decoupling has happened between US and Japan, and now it is happening between US and China. This is a very, very important topic. I'll cover it. Third, and most importantly, I will talk about the impact on you, that with all these wars happening, China-US decoupling happening, how is this going to impact you and your investment, and what strategy you can apply. So let's begin. This is going to be a deeply insightful video. So let me start with this picture, and this shows the overall dominance of the US economy. Okay, when we think about a dominant economy, we just simply measure it in terms of GDP per capita or the total GDP or the growth rate, etc. And we forget about and ignore the other points. Okay, it's like an octopus. Okay, so US economy is like an octopus. It has multiple tentacles, and all these tentacles work together, right? So let me help you understand this, and please imagine US economy to be an octopus, right? Now I will show you the correlation between each. See, first point is fairly straightforward, that from a GDP basis or overall GDP basis, that US economy has like X trillion dollars GDP and other countries have lower GDP. Cool, no problem there. This is just one very small part or one tentacle. Number 2 tentacle is that US dollar is a global reserve currency, right? Now this gives US a lot of power. Okay, this is the second tentacle that US economy has. Now because it has the right to print dollars, it can export inflation to the world, right? So the 2022 inflation episode that we saw in the world, it happened because US started printing money very aggressively post 2020. Okay, now this gives US dollar or US economy a lot of power. Third point, what we need to understand is that the depth of the market in the US is very high. Now let me correlate all these 3 points by telling you a very simple story and by using a very simple example. Now US and China trade a lot. Okay, for example, if US wants Chinese toys, China will manufacture it and send it to the US. In return, US will give China, let's say, $1 billion to export these Chinese toys. Okay, now what will China do with it? Well, it will go and try to invest in US denominated assets. That is the meaning of the depth of the capital market. Now what Chinese typically have been doing is that they end up buying US bonds or US treasuries, which means that whatever excess $1 billion China got by selling Chinese toys to the US market, what will China do with this? Well, the US gives them an option that, hey, you know what, why don't you guys come and loan this money to us? Okay, so China gives them that $1 billion back. Okay, so this is a great ecosystem which kind of works. And how does it work, right? This is where people don't spend any time understanding, right? So see, what you need to understand is that economic output of US is whatever X trillion dollars, but at the same time US has a great thriving domestic market. For example, the entire 2025 trade war started because US started threatening different nations that, hey, Korea, you want to sell your stuff to US citizens, pay us this amount of tariff. India, you want to sell your software product to American consumers, pay us this tariff. So because US has such a thriving consumer base where per capita spending is one of the highest, so to say, and they have a decent population size, this becomes a domestic intrinsically lucrative market. And this is the reason why Donald Trump is playing like a trade war. Okay, so this is an important point that you need to understand. On top of this, what they end up doing is that they control the global trade and institutional influence. So let's say that African nations say that, you know what, America, we don't have enough money to pay you, right? We want to trade with you, but we can't really pay you right now because we are too poor right now. Okay, so what will US do? US will instruct World Bank to loan some money to poor African nations one way or the other. I'm not saying that exactly how this system will play out, but this is one of the mechanics of achieving the eventual goal that, hey, the African nations also end up buying the US debt. Okay, so all these things, that providing a very lucrative market, having US dollar as the reserve currency, having depth of capital market, this allows like a lot of countries to go and buy the US dollar in a way and send it back to the US. Now, what this has done is that this has created a great ecosystem for investors in the US, right? So let me show it to you. So for example, if you study right from World War I, World War II, and look at the history of S&P 500, it has pretty much moved in this straight line. Okay, so it has been moving up like this. Yes, there are phases when there is drawdown, there might be some consolidation phase, this, that stuff, but this point A to point B has been a straight up line, which has kind of lasted for close to 90 years, right? Now, why did this work out? That for 90 years, S&P 500, this has gone up, up and up in a straight line manner. If you understand this simple topic, this sorts out your understanding of geopolitics from an investing point of view, right? Now, juxtapose this question and let me show you another chart. Okay, so here is the chart and here you will see Nikkei. So this is Japanese index, and after 1990, it started to correct very aggressively. So why is it that the S&P 500 kept going up, up and up, but the Japanese index has done nothing for the last 30 odd years? Okay, 30 odd years, it has done close to zero. Why? Right? If you break apart this question, study it more, you will find some very insightful, useful stuff. So let me break it down for you. Okay, so here is the story, and this brings us to topic number 2, which is decoupling of economies from the US, right? So okay, so here are the basics of that story, right? So Japan was a thriving economy back in 1970s, 1980s. In fact, Japan became really strong, and at one point in time, it started challenging the US economic growth. Okay, so it started presenting itself as a powerful alternate center, right? So this was US and this was Japan, and it was starting to go up. And it was why? Because it was excelling at manufacturing. It was adding some value to the overall global economy, be it like manufactured exports in electronics or be it cars. Now, by 1985, US decided to put Japan in its place, right? US basically said that, hey, here is Plaza Accord. You have to sign it. Now, what was the basics of Plaza Accord? Well, they dump a lot of things in it. But long story short, what Plaza Accord basically was able to achieve for the US was that it allowed the US to devalue its currency and forced Japan to increase its currency, okay, or revalue its currency. Now, if you are aware of the post-2010 situation between US and China, again, US was pushing China to be fair in the world trading and devalue its currency. Now, what does this happen? Why is this third point really important? Well, this is important because if US wants to export stuff, okay, export stuff, it would want a weaker currency. And on the flip side, if Japan keeps its currency weak, it will be able to export more. Okay, it will be able to export more. Now, this is a problem that US has already solved while working with Japan. Okay, in a way. So let's look at the basics and backdrop of Plaza Accord. So you'll see, and there are important sentences that I'll highlight, that by mid 1980s, that US dollar has appreciated by 50% over the last 5 years. This led to a trade deficit, and this led to protectionist pressure, right? US manufacturers were suffering, leading to intense pressure on the Congress to pass protectionist tariffs. This again we are seeing in 2025, that where there has been an all-out war. Okay. Then what did US do? Well, then they did Plaza Accord. And what was the core agreement? Well, the G5 nations agreed to coordinated intervention in forex market. They didn't talk. They actively sold dollars and bought other currency to force the dollar's value down. Okay. Now you'll say, or you will think that, hey, dollar or US dollar going down is a bad thing for the US economy. Not necessarily. Okay. If it is being done with a very specific plan. If US dollar goes down, but US is able to shore up its exports, it is going to do well. There is no problem. Now, what is the issue in India right now? For example, our currency is going down, but our exports are not rising. Now, that's a complicated scenario. But what US typically was trying to do by putting in Plaza Accord was that it was trying to kill the export market of Japan. Now, you will see that the Japanese yen skyrocketed. It moved from 240 per dollar to 120. So, almost 100% change in price or valuation. Okay. This led to a recession in Japan. To fight this, Bank of Japan slashed interest rates and it tried to do a lot of things, but the asset bubble burst in Japan. Okay. And this led to the lost decades. So again, let me show you this chart. That Plaza Accord was signed somewhere here, 1985, and it takes 2-3 years for this currency to move and currency fluctuation to work. And as the US dollar depreciated and yen appreciated, it started reflecting in the asset market in Japan, and the asset bubble in Japan popped. So then you will scratch your head and think that, boss, okay, this is something similar which is happening with China also, that China has come very close to US now, and it is manufacturing moat, very similar to how Japan was, and US is also threatened by China. So now US is going to do exactly the same thing with China as it did with Japan. But see, there are two major differences when it comes to China versus Japan. Number one is that Chinese people actually learned from the Japanese model and they became very local in their approach, right? Now, what is the meaning of local in their approach? Let me explain. So basically, China is a PPP model, right? Public-private partnership. A great example of this would be Jack Ma, right? That Jack Ma at one point in time, he was acting out of what the Chinese premier and Chinese government wanted him to act out. He thought that, you know what, he's like the face of capitalism in China, but he was put in his place. He was kidnapped or whatever it was. You guys know the story. So point one is that China follows a PPP model where the government comes out and support private players. Their goal is technological superiority because they understand that if they are able to manufacture more, if they are able to win the AI race, if they are able to win the space exploration race, they are going to eventually get to a point where US is unlikely to hurt. What Japan did was that it depended on free markets. It depended entirely on export. Now, that is not the case in China. Yes, China has export competitiveness, but it also has a good thriving domestic market as of now. Okay, their market has not been financialized yet. The second key point is that China has used its trade surplus from the US in order to gain access to critical resources like rare earth metal, which will define the next layer of growth, right? Which is AI. For example, if you want to make fighter jets, if you want to achieve military competence, if you want to go into space exploration, if you want to make EVs, you require rare earth metals. Now, this is a critical resource that China possesses, and it has been able to weaponize it in terms of this disrupting international order. Okay, so this is a complicated issue, but let me try to give you a high-level summary of this by highlighting 5 points. Okay, number one is that right now US and China are very strong economies, and they are two definite multipolar centers in the world. Okay, this is one. Second key point is that China controls something called as rare earth metals. US controls oil. For example, they have already, sort of de facto built their capacity in Venezuela. They will get that access to oil. US is already the biggest producer of oil. They also have access to oil via Canada. More importantly, take a look at this world map. That US is geographically blessed because it does not have volatile neighbors. Okay, it's very difficult to attack the US, right? So all these are advantages. So China has some advantages and US has oil, which is a massive advantage, or energy needs is something which is already secured by the US. Now, both the other countries, for example, China wants oil, and this was one of the key reasons why this Iran war was started. Why? Because almost 90% plus of supply of oil from Iran used to go to China. Okay, on 90% of Iranian oil supply used to go exclusively to China. And more importantly, they used to take money in yuan. Okay, now that was hurting the US. So they started this entire war. Why? Because they wanted to gain some kind of trade leverage. Otherwise, China would have simply said, right, no, we will not give you rare earth metals and we will cut off your supply to rare earth metals. Now, what can US do? Well, US will say that, you know what? We'll cut your supply to oil. Now, this will escalate, right? One way or the other. And as a result, this new economic trade order will be signed between US and China, and some kind of compromise has to be reached here, right? So it is very clear that we now have two power centers, right? One is US, one is China. We can always debate the strength of these countries, But right now, this is the situation where we are in very, very clearly. Now, what these two countries will try to do? Well, they will try to build their military might. Because if we look at Navy, right now, US has the strongest Navy in the world. It is ahead of China, no doubt about that. But if you compare the overall economic might, one could argue that, hey, China is pretty close, right? Maybe they are 80% close to US. So even if there was a head-on combat between US and China, it would lead to disaster. So given this improving military strength of China, this also becomes a struggle for the US and they need to contain it. Now comes a very natural question that what will help these countries to become even more stronger? The answer is that whoever wins the AI race takes a dominant lead. Okay, so and this is clearly playing out. For example, there are companies like Huawei, which is being supported by the Chinese government. What did US do? US government started supporting companies like Intel and Oracle and the entire AI infrastructure built out. Okay, now why is that so critical? Because companies like Huawei, DeepSeek, you have companies like Google, Microsoft, Meta. These are exactly the companies which will enable either US or China to export its AI stack to the world. Whoever wins the AI race takes at least like 2 decades of lead here. Okay, therefore, right, we are sitting, like one could argue, in a very complicated environment, but from an investing point of view, in a very simple environment, where at this stage you need to create an AI first portfolio. Now, in case you guys have watched this video till this point, I would also like to bring to your notice that I'm starting a fresh portfolio which will be built around AI stocks. In case you want to get access to it, I'm putting the links and description in comment box. You can check it out, right? I will build every single trade. I'll invest $1 million of my own capital, show you how this trade book can be built, how to manage it. This is a very interesting phase, okay? So I hope that this kind of makes sense, right? These 4-5 points, that where are we heading in this decoupling phase and why are we seeing all these wars? So now comes the last and final section that, hey, how should you invest in this phase, right? In this phase of decoupling. Now, a framework that I would encourage you to think about is first principles. So think about what is definitely going to happen in the next 5 years. Now, based on that, you can create your investment thesis. So let me jot down a few key points on my first principles approach as to what I think will definitely happen. So there are 5 key points that I will tell you here, right? Number 1 is that AI is going to go up. This is almost given, right? This is first principles thinking. We are already seeing this trend being playing out, that post 2022, 2023, AI has been on a 20% plus adoption. The contribution of AI to GDP has gone up. Now, is it cost effective? I don't know. Maybe it will become, maybe it will not become. Okay. Number 2, the contribution of EMs or emerging economies is going down, right? This is a fact, right? I'm not trying to diss on India or Brazil or whatever BRICS nation and all that stuff. But emerging economies are emerged because US provided security. Now, the moment they withdraw their security, it kind of hurts us. We are already seeing this play out on INR fall. Okay, so right now, here is INR. It has fallen very aggressively compared to other major currencies and it's not looking good. Okay, so emerging economies are getting hit. The macro thesis there is that, see, China and US are working in their own interest. Every country is getting more and more localized. For example, Russia proved to be a case study that you can just create a localized, thriving ecosystem, aggregate a lot of resources and survive. Now, China and US are also trying to make their economies more localized, so to say, right? And insulate themselves from any global hedge. Now, emerging economies that are import dependent are going to get hurt the most. Unfortunately, India falls in that crosshair, okay? Number 3, volatility on the market is going to go up. Why? Because a lot of uncertain things are going to get factored into the market. For example, no one really anticipated that Iran would end up attacking GCC. Okay, now that created a lot of turmoil in the market. Strait of Hormuz was closed. Now, during such weeks or months, like 1-2 months, the market remained incredibly volatile. Okay, now something might happen with Cuba. Now, then something might happen with Taiwan. Then Russia might annex Ukraine. Who knows? Turkey, it is being talked that it will jump into a war. Okay, so a lot of these volatile pieces of news will come in. So therefore, it makes sense to trade. Okay, number 4th fundamental truth is that, hey, US manufacturing is going to go up. Why? Because that has been the entire use case of starting all these wars. That US is securing its energy need to do what? Okay, to manufacture more, right? So of course, US manufacturing is going to go up. So as a result, investing some money in S&P 500 also makes sense. Okay. Number 5, Chinese manufacturing is going to go down. Why? Because the dominance of world trade of China, especially on manufacturing, is exceedingly high. Now it cannot maintain that market share. US is coming after that. Okay. So now a natural question comes that, okay, fine, US, China manufacturing will come down, but what about tech, right? Because opposite case can be made. The US tech superior, a lot of market share, Chinese tech will come and take market share away. 100% correct. I agree with it. Okay. So should you invest in Chinese tech? Well, this is a point of debate. Okay. Why? Because the structure of the US market is that it allows existence of private wealth. Okay. That, for example, Elon Musk is a trillionaire. No one has a problem with it, or yeah, it's allowed. Okay. In a way. But would someone be allowed, or would investors be allowed to make so much money from Chinese market? The answer is a no. Again, because it goes back to that PPP philosophy that I was speaking about in the earlier phase of the video. So I don't know if it kind of makes sense to buy a lot of tech Chinese stocks, but I would have a hedge. I would invest, right? Which brings me to my seventh and final point, which is around diversification. Okay. More importantly, a qualified point here is that diversification on dips. That gold from its peak is at least 14-15% down. Now it makes sense to add it. Okay. Same guys, right, who are chasing gold. It does not make sense, right? War hua, everything happened, but did the gold prices go up? No, right? But because it was consolidating and then there was a dip. So you can buy the dips. Same thing might happen on US stocks. Same thing might happen on Chinese stocks. Same thing is happening right now on UAE stocks, which I'm adding. So long story short, you have to learn how to be okay with volatility, trade volatility, invest in volatility, and be extremely diversified. That is your only bet. My core still remains AI stocks. So almost 60-70% of my total net worth, I'm happy putting in US AI. Also buy like maybe 10% Chinese stocks, right? And be as diversified as possible on the rest. Okay. So this is my thesis. Would love to hear your feedback. What do you guys think about it? How are you planning your portfolio? Thank you so much for watching, and I'll see you soon.